Once again, coming at you guys with another video. This one is assets, liabilities, and what are they? So, to start off, assets and liabilities are something you gotta know. You're coming into business, period. Any kind of investment or whatever it is, these are two fundamental things you have to know. What are they? And then be able to identify what's an asset and what's a liability. Even within yourself, an asset is something that grows with you. It appreciates. In business, an asset puts money in your pocket, as opposed to a liability, which is something that can take money from you or take money out your pockets. All right, that's general terms. An individual can be a liability. Someone who's bringing danger, something like that, to an element. They're from a dangerous element, and they're around you. They can be a liability towards you. And or you can sit here and turn yourself into an asset, as far as the knowledge you acquire and how you apply that knowledge you acquire and things that you do. You can become an asset to your community. All right, but to get back to the financial terms, assets and liabilities, to keep it simple financially, asset is something that puts money in your pocket. Liability is something that takes money out your pocket. So right here I got two example of asset and a liability, as you can see. Now we're gonna start off with the asset right here. In this particular example, we have a property that is income producing property, which costs $69,000. Now, some people may say, where would you find a property for $69,000? Easy. You can find them in Philadelphia. You can find them in Atlanta. You can find them in Houston. You can find them in some parts of New Jersey. There's many places in this country where you can find prices of property at this particular price point. There's more places to find properties at these price points as opposed to find big markets like New York, LA, the more expensive markets. Now, over here we got an income producing property that's going that you buy for $69,000. In this example, we're gonna say we put down 10% of the purchase price. So that means we're putting down $6,900. So that'll give us a mortgage of $62,100 that we're gonna get. Now, stretched over 30 years. So the income from this particular property, it generates $800 a month, right, for rent. Now, once we get that, we have to subtract our mortgage. And in the mortgage, our monthly payment is going to be mortgage, taxes, insurance, everything all together is going to come up to, and interest, include the interest part. So comes out to $340 a month. So we subtract our monthly expenses from our monthly rent, which gives us a net of $460 a month, right? So that means that this is not every month. This property puts $460 after everything is paid into your pocket, and this is not including any tax benefits you get from appreciation from the property, the land value going up. This is not including depreciation that you can write off as well on your taxes. It's not including if you bought the property underpriced, or if the property appraised for a lot more than you paid for it, or as it grew in time, whatever, which would go for under appreciation. There's equity. It's not including any of those things. So, getting back to this is cash flowing. Right now, we're cash flowing $460 every month net. Now, $460 times 12 months in a year will give us $5,520. So every year, besides tax breaks, besides depreciation that you can write off, besides equity in the property, appreciation, this property is putting $5,500 in your pocket every year. Now, we're going to calculate what's the rate of return that we got. Remember, we put out $6,900 to get this property, 10% of the purchase price. So now we'll take our profit and divide our profit by our investment, and the answer is going to give us our ROI. Now it may come out into a decimal, so you can multiply it by 100, and that'll give you a percentage. So $5,520 a year, this is what we made every year, divided by 6,900, which is the 10% we put down for the property, gives us, this is our profit, 6,900 was our investment, that's what we came out of pocket with, equals 8%. So that means that every year we're getting 8% on our money, 8% return. And once again, it's not including tax breaks, equity, appreciation, anything like that. Now, that would make this an asset because it's growing with you, it's putting money into your pockets. So that's what makes this an asset. The next example over here, we got a Range Rover, 2017 Range. They nice, I like those. However, this Range Rover base costs $88,000, right? I did both of these properties at the same interest rate, 4%, right? 4% interest. Now the payment every month here is $2,969 a month, not including insurance. I didn't include insurance or fuel or anything like that into this. It's brand new, so maintenance is not an issue, or shouldn't be at least. But you still have insurance and fuel. But I'm not even including that into the equation. We're just strictly go for the payment. I'm going to show you. So you have $2,969 a month that you're kicking out every month for this property. So this is coming out your pocket. So you put the same down payment down, $6,900 down on this Range Rover as well, just like you put it on this property. So now that same $6,900, you got a $88,000 vehicle, which now on top of the $6,900 you put out, you're paying another $2,969 every month, besides insurance and fuel costs. So now, at the end of the year, right, we're gonna multiply $2,969 times 12 months in a year. So at the end of the year, you would have kicked out $35,628 for this Range Rover, not including insurance and fuel, once again. So how much money did that Range Rover put in your pocket? None. That would not be a liability. Now, there's ways, you can buy this property. Well, this property is never going to be, this vehicle will never be a liability, right? Unless you have, some sort of business where this is part of your business and you're using the vehicle, then that's a whole different scenario. We're not talking about that. We're talking about the everyday person who's buying a vehicle, who has $6,900 or whatever, and who's looking to who needs to do something with it. So these are your options. This is something that you can pass on to your family. This is some of your kids, your loved ones, whatever, that every month you got $5,520 coming in. You get 40s, you got over $20,000 a year coming in extra. And we're talking about $6,900. You can do that if you decided to buy one every 4 years and put $6,900 down each year. That's fine. So you'll have in 4 years, you'll have over $20,000 extra coming in, besides equity and appreciation and depreciation that you can write off as well. So I just want to give y'all, some insight on what's the difference between an asset and liability, and let you guys see the numbers. Because over here, once again, you're paying out, I'd rather pocket $5,520 every year than come out of my pocket $35,628. But that's just me. Your choice is yours. I just want you guys to see and have the knowledge and be insightful enough to know what's the difference. And then don't get caught up into the trap of keeping up with the Joneses, because wealth doesn't have a look. You know, wealth does not. I'm sure you can. If you look at if you Google image any picture of Steve Jobs or, Bill Gates, any of these guys, you won't find a Gucci belt between any of them in any picture. So there's a big difference with the mentality when it comes to assets and liabilities and how to utilize the money. Problem is, a lot of us haven't been taught that, and school doesn't teach this. It was never designed to teach this in school. So, but I just want you guys to know, so you guys can, see the difference, see the numbers yourself, and understand what's the difference between the asset and the liability, right? Peace. Enjoy your night. Also, you can check us out on Instagram, Flip These Bricks, or follow our YouTube page at Flip These Bricks, right? Peace.